But I think it's a matter of time, frankly.
Yeah, there were a couple of bankers telling me yesterday that, even in the previous cycle, it was not as if the bad loans fell in a very big fashion, but the amount of good loans rose so rapidly that the percentage of bad loans as a percentage of the total book declined, and therefore life could go on.
Treasury book profits, that gives you a good buffer as well.
But actually now, unfortunately, the 75 basis point rate cut has come at a time when there has been a global surge in yields, which has negated what we may have had in terms of an advantage on the yield book, and that's the question I'm coming to now. The surge in yields is obviously presaging an expectation of a Fed rate hike. Do you think that post-hike we will see the calm after the storm? Because the Fed has indicated in several ways that it will hike, but thereafter it's not in step for a series of hikes. So do you think, just as the S&P downgrade, post-downgrade brought a long period of funds rushing in to buy assets, do you think that is an event which might kind of declutter and bring in asset purchases?
My sense is also that it's probably not going to be very disruptive, and my thought process is probably that see, if the world growth was strong, you would see it in different places, especially commodity prices, right? So you're not getting any sign that the developed countries are going to go back to the 2003 to 7 kind of phase.
Okay.
Where all the regions were firing simultaneously.
Okay.
And that's kind of getting reflected.
I just want to point out that the Finance Minister and the Minister of State for Finance, I think that's Mr. Adia, sorry, the Financial Services Secretary are preparing for the bankers' meet. I just want to add that this time the private sector bankers have also been invited, and our reporters phoned in that Shikha Sharma and Aditya Puri and Mr. Kannan from ICICI were also noted in the vicinity of the meeting. It's, of course, a larger public sector bank gathering as well. My sense is that there's going to be a strong pitch from the public sector banks for more capitalization. That's already gone, a letter from the Reserve Bank. So that will be, of course, one part of the conversation. The other thing, of course, we already noticed a lot of base rate cuts in the run-up to this meeting. So that when he calls and says, why have you not transmitted, everyone will say, I did 15 basis, I did 30 basis, or whatever. But nobody is obviously giving 75. Puri separately mentioned in that interview to us that he expects over the next 1 year, maybe a 75 basis, 1 percentage point rate cut. Does that square with your expectation? You think money will get that cheaper in the next 12 months?
Velocity
I'm not looking at
RBI.
Yeah, I mean for you and me.
I think directionally it's pretty clear that rates have to come down in this economy. I don't see too much sign of inflation, whether it be manufacturing or food. Say a monsoon, which is a kind of extraneous thing, but it's difficult to envisage that if globally deflation is a problem, and we have a fairly progressive government which is focused on managing food inflation, it's difficult to forecast that you would get inflation that will surprise you on the upside.
Okay, coming back to the, to what one should be buying now, you mentioned that private sector banks is a good place to be. The other pocket that you have a relatively high exposure in is software. So 15% of your total holdings is in software, names like Infosys, Tech Mahindra, etc. But the last quarter was not a great one for them. What kind of returns would you expect from some of these top-tier technology names?
So we think it's going to be a very steady state kind of sector. Obviously, if a sector is $80–100 billion, you can't expect it to grow like 30–40%. They're going to grow at a very mature pace. Part of the reason we are also attracted to that sector is we think in this world where dollar is tending to be very strong, and the fact that currency depreciation is probably one of the stimulus you need to move this economy along. Probably unlike the 2003 to 7 cycle, we're not going to have a very strong appreciation in the currency.
Okay.
So to that extent, when you look at the valuations today, which relative to the market are quite attractive, given the fact that these are very high ROE cash flow generating companies with a very strong management team, we're kind of attracted to that sector right now.
Okay. Well, I have a couple of very quick questions. When would you say that the slight anti-India phase is over, or rather the selling would be over? Would it be when global yields start stabilizing and softening, Would that be what you would look at, or would you look at FII numbers? And more importantly, until now, you guys, the DIIs, domestic institutions, have been countering the FII sale. Can we expect that trend to continue? Do you see yourself hydrated?
So, taking your second point first, I don't think, I think one of the strongest points for this market is domestic savings moving into equity. Maybe there'll be a blip here or there, but I think it's a bit more structural in the sense that if you look at real estate, gold, etc., we still think that the shift from that to equities is a multi-year theme. So we're going to see domestic investors move into bonds and equities from a multi-year perspective, I think. So that part, I think, is not a debate. Coming to your question of foreigners, that's more difficult to gauge because obviously it's subject to global risk on, risk off. But again, there probably, if the currency was a bit more competitive, foreigners would be more attracted. So maybe that is a kind of small trigger that can happen.
A weakening of the rupee. Finally, we are waiting for it, actually. Manish Gunwani, it was a pleasure speaking with you. Thank you very much for joining us on what's a crucial day for the markets.